Did you know that companies can pay you regularly for owning their stocks? So you buy a stock, do nothing and just get paid. It's called a dividend. And in this video, I'm going to tell you what dividends are, how they work, how to calculate returns, and most importantly, I'm going to give you a list of 5 companies that pay pretty good dividends. So be sure to watch this video to the end and we are going to get started. Interested? Let's go! Well, on to the most interesting part. Which companies are willing to pay dividends? JP Morgan Chase, one of the largest banks in the world, has an impressive history of paying dividends going back a long way. Previous to the financial crisis of the 2008 year, the bank paid an annual dividend of $1.52. After the market collapse, however, the payments were reduced to 20 cents. Since then, the bank has begun to increase its dividend annually, and it has reached its highest level in 2 decades, surpassing the level before the crisis. Not only dividends, but JP Morgan's stock price has risen significantly in that time, providing stockholders with additional income opportunities. Investors can use dividends as a source of income or reinvest them by buying more stock and thus increasing their returns over time. Of course, company stock prices have not always moved exclusively upward. However, even during periods of declining stock prices, investors have continued to receive capital from the company, making it one of the most attractive dividend stocks. Moreover, bank stocks such as JP Morgan have benefited from rising interest rates. This is because banks can lend at higher rates, which increases their margins. Sounds complicated, but just know that this is good for the company. The second company is Johnson & Johnson. Despite its relatively low dividend yield, it offers a great balance between steady dividend growth and stock price stability. The company has increased its dividend for 56 consecutive years, making it a defensive type stock that performs well in any economic environment. As one of the largest manufacturers of medical and pharmaceutical products in the world, Johnson & Johnson enjoys strong demand for its products regardless of what happens in their economy. The company's investors benefit from both a rising stock price and stable dividends, which create security and stability in their investment portfolios. This emphasizes the company's stability and its ability to provide investors with stable returns even during difficult economic periods. Next up we have Unilever plc. Founded in 1885, the company has a rich history and is one of the largest producers of consumer goods, including food and household chemicals. Unilever sells such world-famous brands as Dove, Lipton, and Ben & Jerry's. Its wide range of products and global reach, including growing markets in Africa, China, and India, make it one of the leaders in its sector and one of the best dividend stocks in the United Kingdom. Unilever stock is listed on several stock exchanges as there are 2 companies operating under the company's brand. This diversification gives investors additional opportunities to make money on exchange rate differences. However, Unilever's main advantage remains the steady growth of its stock price since the 19th year. There are few dividend stocks in the United Kingdom that can boast the same stability. The first company is GlaxoSmithKline. It's one of the largest medical and pharmaceutical companies in the world with a market capitalization on over 80 billion sterling. The company specializes in pharmaceuticals, vaccines, and healthcare products. One of the main reasons why GlaxoSmithKline stock is popular among investors is its high dividend income. However, the stock prices of pharmaceutical companies like GlaxoSmithKline are often subject to significant volatility. This because it can take billions of pounds to develop new medicines. That is not always the case that these developments go through clinical tests. Despite the high risks, successful studies can dramatically increase the value of a stock, whereas failed tests can lead to significant losses. However, those investors who are confident in their ability to predict stock price movements and want to take advantage of a high dividend yield may want to consider GlaxoSmithKline as a potential investment. And the second company for today is Kinder Morgan. US-based Kinder Morgan is an oil and gas line management company operating in the energy sector. With its robust business model and regular generous dividend payments, it has earned a place among the best high dividend income stocks. Kinder Morgan makes long-term contracts with clients on a commission basis, which allows it not to be directly affected by change in oil and gas prices. Thus, the current rise in energy prices has not caused the company to record profits. However, it has also brought certain benefits. In the year 2012, when oil prices dropped rapidly, the long-term contracts held by Kinder Morgan significantly reduced its losses compared to other companies in the industry. When choosing high dividend income stocks, these reliable, predictable, and perhaps even boring sources of income make a company attractive to investors. Today, we looked at 5 stocks with high dividend income, focusing on this metric. However, when investing for income, dividend yield is just one of many factors to consider. You often hear the opinion that the higher the dividend yield, the better. But this is not always true. A company may have a high dividend yield at the moment, but can it maintain that level in the future? How does it produce income to pay dividends, and will it be able to continue to rely on that income in the future? What is the risk of loss of investment capital? It's worth considering all these aspects. Another important indicator when choosing dividend stocks is the dividend payout factor. It shows how much of the company's profits are paid out as dividends. For example, if the company paid a dividend of 30 pence per stock and earnings per stock were £1, the dividend payout rate would be 30%. It's ideal if the dividend payout factor is less than 50%, as the remaining profits will be reinvested into the company to provide growth and therefore increase future dividends. We have more videos on our channel about cryptocurrency, finance, and earning. Go ahead and watch them. I hope you found it useful. Thank you for watching. Like and subscribe, and I will see you in the next video.